Hey Kevin, we're back again to talk to our clients and get some information out there. To me, it was a fascinating week, or actually, it's been a fascinating month. The markets have been up for a month. Now we'll talk about that more in a minute. But the point of today is just to talk about what we can learn from the economy, what we can learn from the markets. Are we in the clear? Kevin, it's confusing. Are we in the clear? Are we in a recession? We've had 2 quarters of negative GDP, which is a common definition. Or, Kevin, my favorite phrase ever, I want to mention this as many times as I can today. Is this a dead cat bounce?
Yeah. So Charlie, I've never tried to bounce a dead cat, but I know that's one of those expressions that just means that the market goes back up for a short period of time during a bear market,
Yeah.
which is more than 20% downturn. And then it's dead cat because then it goes back down again.
Yeah.
And so we as human beings love to put labels on
Yeah.
everything. Is this a bull? Is this a bear? Is this a dead cat? Is this a V shape? Is this a I mean, we just love labels, but the
Yep.
truth is, Charlie, we never really know what's going on during that
Yep.
time period. We know afterwards.
Yep. That's right. I'm going to quote one of our favorite bloggers, Ben Carlson, A Wealth of Common Sense. Go check out his blog. It's awesome. But then I'm going to kind of go through a little bit of data as well, because Ben Carlson says it best. The good news is I have yet to find an investment plan where its success or failure is predicated on your ability to predict tops and bottoms in the stock market. I think that's kind of a really important point, because I'm going to go through this. Kevin, yesterday got back from church. I'm reading the Wall Street Journal, the physical, real paper. I've got it right here somewhere. It's kind of old school. Most of the time I fall asleep while I'm reading, Kevin. That's kind of the point of it all. But this time, a couple articles caught my attention. One of them was titled Inflation, Slowdown Point to Bumpy Economic Transition. The second one was Markets Post Best Month Since 2020. That's what got my attention a lot, because has anybody talked about how the S&P has basically been up 10% the last 30 days? It's pretty amazing, huh?
Yeah, I think that's why the dead cat bounce has been mentioned
Yeah.
so many times and so frequently, because it now seems like after the market was going down, it now seems like the market is going up.
Yeah.
What's dangerous about that?
That's right. It's irrelevant, right?
Yeah, well,
Past
the
performance.
market every day, everyone in the world comes in to work or wherever they are, and they decide, should I buy, should I sell? And
That's right.
if the news is better than expected, many times the market will go up that day. If the news is worse than expected, many times the market will go down that day. And everything about future market performance is based on the future.
That's right. Yeah. And that uncertainty is really hard for us as human beings to deal with. So I'm going to throw some examples out here, Kevin, from these articles that I thought were fascinating. And that is, as we, as consumers, as advisors, trying to get our brains wrapped around what's going on in the economy, it's really challenging. So here's the article from that Wall Street Journal yesterday, the article called Inflation, Slowdown Points to Bumpy Economic Transition. So this was more economic based, not market based, but let me just go through a couple points here. The good news that I put was wages and benefits rose 5.1% in the second quarter, 2022, from a year earlier, right? That's awesome. The bad news is, guess what? A tight labor market could continue to exert upward pressure on consumer prices. A more closely watched measure, which rose 9.1% in June. The Fed is briskly raising interest rates in an attempt to slow the economy and inflation. So, okay, there's a couple points there. To me, I kind of come to the conclusion, okay, higher wages, more spending, higher interest rates from the Fed to cool the economy down. The last thing I'll read here is the Wall Street Journal quotes, it says, those interest rate increases have already dented the housing market and appear to be filtering more broadly into the economy. A steep decline in residential investment, a pullback in business spending, and weaker inventory restocking contributed to U.S. gross domestic product shrinking at a 0.9% annual rate from April to June. It's the second straight quarter the economic output contracted.
Yeah, so good news is good news and bad news is bad news. Not always.
I know.
That was bad news. And that day when that came out, the market roared higher because
Yeah.
things were terrible.
Yep.
And therefore, inflation's probably going to get under control. And the economy is not that great. So the Fed does not have to keep raising rates. So
Yeah.
there's been a lot of bad news in the last month,
Yep.
but a lot of the bad news was good news. And I'm confused.
It's fascinating, Kevin, because there was at one point the markets went up because the economy was so bad that they said the Chairman Powell will not have to raise rates as fast. So,
Yeah.
all right. So anyway, that's the economy. So shift gears away from the economy for a second. We got news about the stock market. The S&P gained 9.1% in July. The NASDAQ climbed 12%. Another quote from that article: investors have taken comfort in recent days from the idea that the slowing economic growth might encourage the Fed to raise rates at a slower clip. So there's more,
Yeah.
Kevin. I mean, it's just like, what in the world? I think who wins here? The press wins because everything is bad news, I think, right?
Yeah. Yeah. Well, what was interesting to me the last week of July, I read that ETF flows were coming back strong.
Mm-hmm.
And that was pretty much after the market had run up 6% or 7%. Yeah. Bond market ETFs, very strong. That was, after a good July. So it's like when things were going down, people were pulling money out. Now, all of a sudden, people are flooding back in. So continue.
Yep. Oh, yeah. It's just fascinating. Let's see. 73% of the companies in the S&P 500 have reported quarterly results have beaten their profit forecast. So again, it's such a confusing economy because we have this bad news and it's difficult. But at the same time, these companies are making money, and profits are really what drives the stock market. Earnings is what drives the markets, right?
Well, what's interesting about that 72% is it's actually low for when companies predict how much money they make, they usually sandbag a little. Yeah. So the 72% is actually a lower amount. So, the other story narrative that I've heard in the last couple of weeks is that, companies have tossed out all the bad news and things are not as bad as the market expected. Once again, it's about expected. Yes. So a lot of companies came out, Microsoft and Google and many other companies came out with quarters that were kind of not that good, but all the stocks went up after not all, but most of the stocks went up after they reported results. And that's just because the market was expecting worse.
That's the truth. It's it's based on those expectations like you talked about. Another quote here from Ben Carlson. He says, this is likely the weirdest economy any of us have ever seen or will ever see again in our lifetimes. COVID crashes the economy, then we had all of that stimulus give us a sugar high, and now comes the hangover. That's just his interpretation. But the good news here, Kevin, is as investors, as savers trying to prepare for our retirement, I don't have to know this stuff. I mean, you and I try to figure this out because we want to educate, we want to help provide perspective. But as a saver and an investor, we don't have to wrap our brains around this confusing data. And I think that's important.
Well, I'll just say the market is a loony bin in the short run. I mean, there's a lot of other people that quoted it better than that, but and the big question that we often ask is, does it matter what happens in the short run? I mean, the big lie in investing is that you have to pay attention right now because the market might go down. Yeah. Well, over long periods of time, the markets go up. They may not always. I mean, that's really the big risk is that they may not always go up and they may not go up over decades. But, looking back on history, you weren't able to predict when these bad events were going to happen, and just wait them out.
That's right. Yeah. And I love what you said earlier. You talked about that narrative, that I'm talking about and kind of read in these articles. The news loves a narrative. They love a story. That's what they do. But as investors, and this is going to sound weird, we don't care about narratives. We don't care about stories because we care about data. We care about the evidence. And that's how we design our investment strategies, is what does the evidence say? We don't really care about a recent narrative or a story explaining some technology or some economic circumstance or event.
Well, Charlie, I just watched Amazon Prime Outer Range, and I'll tell you, I do like a good story. I will confess. That was a really bizarre show. I loved it. But the thing is when it comes to investing, I can't tell you how many times in the last month people have asked me, they said, what's going to happen? And they've
Mhm.
presented a story to me. And I'm like, good story, could happen. Don't
Yeah,
know.
that's right.
Don't
Let
know.
me give a couple bullet points, and then we're going to go to the slide that you have that I think is pretty awesome. The last Ben Carlson quote, because he just says it so well: investing for the long haul requires preparation for a wide range of outcomes, to both the upside and the downside. And in other words, we've said it many times, as investors, all of us are investors, but especially as advisors, we have to prepare for multiple outcomes, and we have to prepare. If you're a narrative investor, for sure, you better prepare to be wrong. That's why we like to rely on the data more than anything. A couple bullet points, and then I'm going to hand it off to you. Keep investing when the markets are down, especially when the markets are down. People kind of want to stop, like, this is scary, I should stop. This is absolutely when you should continue to invest, because obviously we're buying those companies, those equities at a lower price. Control what you can control, and that could be the overarching theme here. But we talked about being prepared for multiple scenarios. We also want to stress that past performance is irrelevant. What happened yesterday or last month, and the dead cat bounce thing. See, I got that in there again, Kevin, is so funny, and it's important because we don't know if this is the bottom. We could go lower from here. It could have been, just a temporary thing. Some people think it is. So past performance is not relevant. You have to keep with your plan and keep investing, and understand why you're investing. The last thing I'll say there, Kevin, is set a framework for financial decisions in your life, such as, are you saving in the right accounts? Are you saving the right amounts? If I'm doing all these things, go out and try to enjoy your life, and maybe understand that the news media, the news stories out there are not always so relevant to your investing game plan.
Yeah. So Charlie, now I'm going to talk about past performance.
I love it. Yeah.
after
Let's see
that,
it.
past performance doesn't matter. But before I do, I'll just say this as well. When I first became a financial planner and markets went down, I would apologize a lot to clients, and I always felt really bad. I still do. But what I've learned is that these market downturns are actually the time when we actually learn.
Mm-hmm.
And if we can ignore these market downturns, that's really the key to becoming a good investor.
Mm-hmm.
So let me go ahead and pull up. So when I said I'm going to show past returns, I'm really going to show, and I'll start out with the 10%. I'm really going to show what's happened with the stock market since 1926. Often, Charlie, I don't know if you ever heard this expression, but people say things are crazy now.
Mm-hmm.
The market is crazy now. The world is crazy now. Well, there's been many times in the past the world has been crazy for different reasons. I asked my son Chris recently. I said, "Hey, what was the best time to live in history?" And he started going, and he couldn't figure out. He was like, "Oh yeah, that wasn't good. Oh yeah, that wasn't good." There's always something going on.
Yeah.
So this is the Depression, and I mean, look at that. That's a bear market, 85% down, but year after year. But the thing that's interesting to me about the 10 percenters is that they happen pretty often. And recently they're happening even more. And we don't know why, although I would guess it's because information travels so fast. We have more frequent ups and downs. Now, the other thing that we notice is that the time periods of good have outranked the time periods of bad. So all you've had to do is sit quietly for even the 2000 crash. Now the 2008, 2009 correction, that was not fast. That was painful. The 2020 was one of the fastest ones ever. Now that's the downturn. Now we look at bear markets, and bear markets are more than 20%. The thing I ask people to look at with this is, how do you know when there's a dead cat bounce or the market is going to go back up? Well, you look at these graphs and they're a little bit hard to see, but right there, that looks like that was going to be the bottom. Market goes back up. That is the dead cat bounce there. We didn't have one. I guess we had a slight downturn of 20%. And then in 2008 and 9, we had multiple dead cat bounces, but ultimately the market went back up, and you just can't tell.
Yeah.
And again, back to 1926 to now, the blues are the runs that the markets have gone on. The reds are what we fear. And this is funny and not funny, but since 2008, I've been in this business, and every single year, people have been afraid of the big one,
Hmm.
and they've gotten out of the market. This was the bump in 2020, and now we just had another one. Is
Hmm.
this going to be going down again? Are we going to have a dead cat bounce, or are we
Hmm.
going to go back up? Who knows?
Yeah.
I sure don't know, Charlie.
Yeah. The one thing I think about, Kevin, is if I don't participate, if I'm not present in those blue upturns that you showed, then I'm really going to get hammered when the red comes along. So I've got to make sure that I'm present for those for the good times. So that's something that I think about a lot.
Yeah, if you were in the market the last 10 years and you just had a massive 24% downdraft, boy, you're still sitting pretty
Yeah,
compared
that's
to
right.
if you put the money in the bank 10 years ago.
Yeah.
So again, there's no guarantee that that's going to continue in the future, but I think stock investors, because they're taking on more risk, will probably be rewarded greater than bonds, cash, and many other asset classes.
Yep, that's right, Kevin. And part of that preparing for multiple scenarios, like we talked about earlier, is having a diversified portfolio. We sound like a broken record, and it's almost cliche to say that, but that is absolutely true. In that, when you have a globally diversified portfolio with bonds in there as well, even though they've not done that great lately, we're going to be able to sustain and survive most of those difficult times all over the world through various parts of our history.
Yeah, absolutely. Absolutely. Even bonds are back up in July. You're
Yeah,
buying bonds in this market with inflation? Are you crazy?
that's
Oh,
right.
they went up?
That's right. Excellent. Kevin, anything else for our clients or those that might be watching today?
No, thank you very much for your time.
Thank you. We appreciate you, and we'll talk to you again shortly. Thank you.